Welcome back. Today we're going to talk about flexible budgets. I'm going to share my screen and we're going to get into presentation. So flexible budgets is actually something that follows by regular budgets, but is flexible, the word itself, means that you are leaving some room for things changing, and you might not be as strict measuring things, and you might be looking more in a variances as things change in your organization. So kind of let's take a look at the circle of life here. When we look at a performance report, right? When we look at a performance report, what do we measure our performance against? We have to have some kind of standard. So we kind of going to begin with analyzing variances against what we were thinking we're going to have, right? So we're going to raise the questions. What should have been? Identify roots of a cause. Should we change some structure of how we're going to monitor some of our costs? We're going to take some actions and conduct next period of operation. So every period you can actually change your budget based on a variance analysis, and this is kind of where flexible budgets work. It does not work for all organizations, but smaller businesses that might have variations based on the weather, conditions of a flu season, and so on, might look in some of those micro variance budgets to determine kind of quick on the spot determination how should be they doing. That didn't sound right, but you get the point. So how would we go about preparing flexible budget and understand? We still have to do some planning, so we cannot just say, okay, we're just going to see what's happening. We're going to plan it based on activity levels. So how many units are we planning to have under a certain level? So if I have a small grocery store, right, you have a certain level of activity. And if you have a big chain store, you have a different level of activity. So you're planning a budget based on the level of activity within the size of organization. Performance evaluation is difficult when activity levels changes all the time. So you cannot expect performance from a smaller scale store the same as a bigger scale store. What is the characteristics of flexible budget? You might be prepared for any activity level in a relevant range. So let's say anything under $1 million sale, for example, or within so many customers visiting. Show costs that should have been incurred in the actual level of activity enable apples to apples cost comparison, and help management control some costs and relatively quick and improve a performance evaluation. So the best way to look at this is actually we're going to go to Larry's Lawn Services and take a look how he's running the business and how we can help him to run the business using flexible budgets. This is information we're going to be using going forward for this particular problem. Larry Loan Service provides loan care and plan community where all loans are approximately the same sizes. So the same neighborhood, the same size lot sizes. And this would be different if it's a different lot sizes. Obviously, we would maybe have to come up with a different cost drivers. And this is why this example could be different for different companies. At the end of May, Larry prepared his June budget based on mowing 500 lawns. And since all of the loans are similar in size, Larry felt that the number of lawns mowed in the months would be the best way to measure overall activity for his business. So you might have a business where you did not pick up a best activity. What if it's miles driven to the job? But if it's in the same neighborhood, obviously maybe lawns. What if it's in this particular business, the size of lawns are different. Maybe you're using square footage for activity base. So you might be changing what you're using as a measurement for your flexible budget and how you're doing the calculation. But in this case, we're going to use number of lawns to get a point across. So here we have our planned budget, and he charges $75 per lawn. So he's anticipating 75 times 500 to earn 37,500 revenue, the following expenses are as follows. For wages, there's $5,000 fixed cost plus $30 variable cost, so times number of loans. So 5,000 plus 30 times 500 equals to 20,000. Then we have gasoline and supply, so we have a variable cost because we see times Q is number of loans. Equipment and maintenance, again, this is all variable cost. And then we have our fixed costs because they don't change with a Q, right? So office and shop utilities, office and shop rent, equipment depreciation, and insurance, they're all staying static here. Okay, and I think I just see if I can move this out a little bit for us not to see that. Okay, here we go. Okay. A little bit better, but not. So net operating income is 5,000. So this is our June 30th budget, planning budget for 500. So how would it change, or what would happen if we have number of loans as 550? All we did is we plugged a Q for 550, and we resulted in net operating income of 6,450. Of course, it's better, right? You expect to receive more money, obviously, because it's extra 50 loans, and our fixed expenses did not change, but our variable expenses did. So how would we analyze this? How would we look at this? So Larry actual result compares with planning budget, the variances. And I know you guys gonna probably look at this and say, well, you're comparing not apples to apples. You're comparing 550 to 500. But remember, we're looking at the results. So we're going to say, okay, revenue, it's much more favorable. We made more money. So that's a great thing. Wages and gasoline expense both unfavorable because the Q here increased our cost. However, look at that. Equipment maintenance and office supplies are both favorable. Something happened to insurance. So even though it's fixed cost, we still have to look into it. Something changed there, right? So overall, my total expense is 4,050 unfavorable, but net income is favorable. But you cannot ignore it because even right here, right, without looking at anything else, our insurance went up. Why? Did we hire a minor under certain age and we have to consider insurance going up, and that's something that going forward should be a fixed cost? Why are we getting charged more? Why office shop utilities, which went down? So those costs need to be asked going forward, or try to understand it. Is that unfavorable here? Is it proportionate to what we anticipated to be? We still have to be able to measure that. So this is something we have to look into it in details. This is the same thing I just mentioned, just as a little highlights here. And we want to investigate. So unfavorable, has Larry done a poor job controlling the cost, or is it just has to do with the number of quantity of the loans we did? So at this point, we cannot answer those questions because actual level of activity is greater than planned level of activity, and therefore actual variable cost likely to be higher. So we already knew that, and there's nothing we're going to change. So the relevant question is, how much of the cost variance are due to a higher activity and how much are due to the cost control? And that's a big question. So to answer this question, we need to flex the planning budget. So to accommodate the actual level of activity. So we're going to flex the planning budget right now. To flex a budget, we need to know the following. We need to know total variable cost change in direct proportion to change in activity. So for those 550 loans, we have to calculate that. And total fixed costs remain unchanged within relevant range. So let's prepare a flexible budget for Larry Loan Service. If we're going to prepare using our formula, we're going to see for flexible budget based on the previous anticipated budget, we should have ended up with a net operating income of 6,650, and the following costs should have been there. Now, if we actually going to attribute all our costs, and activity variance arise solely due to the difference in actual level of activity, and the level of activity included in the planning budget. So this is activity variances that we're going to be looking at. So we're going to use flexible budgeting concepts to compute activity variances. So our activity variances that we seeing here, right, has to do with us going from 550 to 500. So the activity variances more have to do with us actually increasing the number of loans we serviced. However, activity and revenue increased by 10%, but net operating income increased by more than 10% due to presence of fixed costs, because we know once we bypass that break-even point with the leverage that we learned before, we earn more money. So 10% higher actually increased our net income much higher level. Okay, so if we look at actual revenue versus flexible budget revenue, the difference is a revenue variance. If we look at an actual cost versus flexible budget cost, we're looking at a difference in a spending variance. So revenue variance versus a spending variance, what we are actually spending. So flexible budget concept is computed revenue and spending variance for Larry loans. So we're going to go to the next step of our calculation. Now we're calculating actual results with a flexible budget for 550. So revenue right now, we actually have a favorable revenue of 1,750. So for 550 loans, if you maybe already did this, times 75, you would end up getting 41,250. But we actually earn 1,750 more. So did we charge more? Did we had expedite work? Did we found a bigger lot? Is it because we are so busy we said, it's the last moment, we're going to charge more? So what's going on here? I mean, it's great, but we need to understand this so we can plan accordingly. However, look what happened here. We charge more, right? We made more money, but we end up paying more salaries as our employees. Overtime end up costing us more because they had to stay overtime to pick up that extra 50 loans. This is proportionately labor costs us more. It's gasoline and supplies. And now there's nothing wrong with maybe paying overtime, but are we pricing that extra above our capacity at the right price? So those questions can start coming up. Equipment and maintenance is favorable, so we don't have to utilize more equipment. Office and shop is 50, and again, we had insurance of unfavorable 200. So overall, my net operating income is $200 unfavorable due to those extra 50 loans. So this right here, we comparing flexible budget to the actual results, and this is our revenue and spending variance combined together at the same level of activities. And this is our spending variance. So when we need to prepare a performance report, and that's actually combines both, and I really like this report, and kind of puts everything together. We take our activity variance and revenue and spending variance and puts it all in one place, and it really kind of brings it all together. So my revenue and spending variance compares 550 and 550. This is the one we just calculated on the same level, actual versus flexible. And here we actually comparing my actual results with planning results, and that's the one we did originally. So this is a good way to analyze where we stand. So if we just compare, obviously, oh yeah, of course, take extra 50 loans, that's great. You get a favorable bottom line. But if you start digging closer to the cost, you definitely want to make sure you evaluate where the money is going, why are we charging more, yet we still cannot control a variable cost here. All right. So this is definitely something to look into it in more detail and understand. And flexible budgets are a little bit more simple. We don't have the same thing as we did for regular budgets when we go through the production and so on. So it's everything in one place. It's a quick thing. And a lot of smaller companies that, especially if they have one cost driver, it is much more complex, and we'll look into it when you have more than just the lawns. You have a tree trimming, let's say, and landscaping and lawn services. Now you start getting into more and more variables going on. So something to mention, nonprofit organizations do this as well. And they actually might receive funding from sources that other than sales, goods, and services. So revenue may consider both fixed and variable revenues elements. So when we look at a revenue, it's not just one component. So you can have a state funding, tuition and fees, donation, endowments. So that could be combined, sometimes based on enrollment, sometimes it's based on just how many schools in the state and so on. So it is very critical to understand it's not sometimes just a quantity driven. Let's talk about performance reports and cost centers a little bit. Performance reports are often prepared in cost centers. So you would have, I'm going to go back to grocery store, and let's say we have a deli, we have a meat department, we have a milk department, we have a fruits and vegetable department. So they, each of them might have a cost center. And actually a lot of companies would just have a cost center, and revenue center might be something separate from it. But in the grocery store, the revenue and cost center probably most likely be put together. Those reports should be prepared using the same principle discussed so far, except for the fact those reports will not contain revenue or net operating income variances. You're just controlling your cost. So if I look at a manufacturing facility, I'm just controlling my cost, and sales department that sells, going back to my combines and tractors, they would control the revenue goals, and manufacturing would control cost of the product. Okay, prepare a flexible budget with more than one cost driver. So as I mentioned, you can be doing more than just a loan. So if you have more than one cost driver, you might need to adequately explain all the costs in an organization. And cost formula used to prepare a flexible budget might be much more elaborate. So you might have how many airlines might be using that, how many passengers on the flight, and how many planes do they land, the cost, how much airport would be charging airline company for landing airplanes. So those things are all a big factor. Because of the time required for edging and trimming is different for different lawns, Larry decided to add an additional cost driver, hours, for the time required for edging and trimming. So Larry estimated the additional hours and develop a new flexible budget. So we add into what we had before that includes the second cost driver for both revenue and expenses. So he's doing revenue and expenses, but again, some organization might be responsible only one thing. So for this case, we have number of lawns still Q, but number of hours required to do edging will be 25 times H, right? So, and this is kind of interesting. For sake of this example, we can kind of see that it's not going to be making much money, right? Because right there, just kind of breaks him even. Maybe he'll make some money, but he's really charging what he's paying his employees, right? So that doesn't, but they're already on the job site and so on. So, but we're not here to advise him on his cost model. We're here just to look at his variances. So in this case, we have two cost drivers. So we're going to look at number of lawns times number of hours. And gasoline and equipment also have two drivers in here. So most common error when preparing performance resource is to implicitly assume that all costs are fixed, which is not the case, and or all costs are variable. So going back to this, right, we have quite a few variable costs and quite a few fixed costs here. So we need to understand which ones move and which ones do not. And you would want to investigate. So with this chapter, we have probably more questions and answers when we trying to help a client or understand our organization structure. This could be a home budget, right? Okay, this week a cousin is coming to stay with us, or for number of people for food shopping. I spend $50 a person for food, so number of Q people staying in the household just went up. plus, maybe electricity or water bill goes up based on how many people are in a household because more people are taking showers. So those numbers could be changing. All right. So faulty analysis comparing budget among the actual amounts. So what we did before, right? 550 versus 500. Again, this is not apples to apples. It would not be a good idea to prepare different activity levels. Now, faulty analysis assume all budget items are variable. We cannot increase everything by 110%. So that would not be also a good idea. We cannot increase everything by 10% because boom, right here, we increase everything by 10%. Well, fixed costs do not get increased by the 10%. So this is something we would not do. So this chapter is very good summary of what to do with flex budgets. It's very useful, quick tool for companies to use, especially for cost centers. And it's something they can review on an ongoing basis. So good luck with this material, and I'm here for you if you have any questions.